Most people don't avoid investing because they don't have money. They avoid it because they're afraid of doing it wrong. So they do nothing, which, ironically, is often the most expensive mistake of all. In the next 5 minutes, I'm going to walk you through exactly where a true beginner should start with investing step by step. No confusing jargon. Before you invest a single rupee, there are 2 things that need to be in place. First, a basic emergency fund, because investments can lose value in the short term, and you never want to be forced to sell at a bad time just because life threw an unexpected expense at you. Second, high-interest debt should generally be addressed first, because the interest you're paying on that debt is often higher than the returns most investments realistically offer. Once those foundations are handled, the real starting point isn't picking a stock, it's understanding what you're actually trying to do with your money, and by when. This is called defining your goal and time horizon. Money you'll need in the next year or 2 behaves very differently from money you won't touch for 20 years, and that difference should shape where it goes. Short-term money generally belongs somewhere stable and easily accessible. Long-term money can afford to take on more short-term ups and downs in exchange for greater growth potential over time. Now let's talk about the actual building blocks beginners should understand, in plain language. Stocks represent ownership in a company. When the company grows in value, your share can grow with it, but individual stocks can also be volatile and unpredictable, especially in the short term. Bonds are essentially loans you give to a government or company in exchange for interest payments, generally more stable, generally lower growth potential. Mutual funds and index funds pool money from many investors into a diversified basket of stocks or bonds, which is often a beginner-friendly starting point because you're not betting everything on one single company's performance. Here's the concept that matters more than any specific investment choice: diversification. Spreading your money across different types of investments, instead of concentrating it all in one place, reduces the damage any single bad outcome can do to your overall plan. Beginners who try to pick individual, winning stocks often underperform beginners who simply invest consistently in a diversified, broad-based fund and leave it alone. Speaking of leaving it alone, consistency beats timing. Trying to predict the perfect moment to invest is something even professionals struggle to do reliably. What actually works for most beginners is investing a fixed amount regularly, regardless of what the market is doing that week. This approach smooths out the highs and lows over time and removes the pressure of trying to be perfectly right about market timing. A word of caution as a true beginner: be extremely skeptical of anything promising guaranteed high returns with little to no risk. That combination essentially doesn't exist in real investing, and it's one of the most common patterns behind scams that specifically target new investors. So, practically, where should a beginner start? Build your emergency fund, clear high-interest debt, define your goal and time horizon. Start with diversified, broad-based options rather than picking individual stocks, and invest consistently rather than trying to time the market perfectly. Investing isn't about being brilliant. It's about starting early, staying consistent, and not letting fear of doing it wrong keep you doing nothing at all. This video is educational, not personalized financial advice. Investment products, risk, and taxation vary, so consider researching specific options or speaking with a licensed financial advisor before you begin. If this made investing feel less intimidating, hit like and subscribe, because your first step into investing shouldn't be complicated. It should just be a starting point you actually take.